welcome everyone. My name is Lisa Rodriguez with NuView Trust Company. We're going to just give it a few seconds, maybe a minute here to get people logged in and available here to watch our webinar. Well, welcome everybody again. I appreciate your time and joining us today to learn more about how the wealthy invest during these volatile times. Just to give you a little bit of background on NuView, we've been in business since '03. We currently have over $2 billion in assets under custody, and we are a trust company, and we help facilitate self-directed IRAs, right? So self-directed IRA is basically a marketing term. If you have a traditional IRA with another firm or another custodian and you want to transfer that money over to us, it's still coming over as an IRA. So the self and self-directed is actually you. So you you tell us where you would like the funds to go and we facilitate that for you. Some of the benefits of a self-directed IRA is true diversification. So we hear people say, you know, I feel like I'm diversified. I'm in these stocks and I have bonds and I have some mutual funds, but true diversification means that you're also outside of the stock market. So investing in real assets rather than Wall Street into Main Street, right? So doing this self-direction, obviously there are tax benefits, right? And then a lot of times we have people that are investing already outside of their IRA in things like real estate. Maybe that's multifamily or commercial real estate or self-storage, right? And so now they have the opportunity to use their retirement funds to invest in something that they know and they feel comfortable with. On this next slide, we talk about the opportunities and the types of plans that we offer here at NuView, and also what those yearly contribution limits are. So we offer the traditional and Roth IRAs. We also have employer plans such as the solo QRP, SEP, and simple IRAs. And then we have specialty plans, so health savings account and educational savings account. Here are some of the investment options that we see our clients invest in. So private entities, things like limited partnerships and joint ventures, also LLCs and trusts. We also have people that invest in real estate, so tax liens and foreclosure apartments, real estate, condominiums. And then we also have clients that invest in cryptocurrencies. So that's another option that we offer here. And then promissory notes, which are becoming more popular as interest rates rise. Without further ado, I would like to introduce our guest speakers today. We have Cody Laughlin and Vacant Alfaro. And just to give you a little bit of background on Cody, he is the co-founder and managing partner of Blue Rock Capital. And he is the director of acquisitions and CIO who oversees the company's acquisitions and business development. He has 11 years of experience in alternative investments. And prior to Blue Oak Capital, he was the founder and president of Laughlin Investment Group, a privately held real estate investment group where he managed the company's acquisition portfolio of residential real estate. In addition, he has worked as a registered nurse at the Texas Medical Center, and he's a graduate of McNeese State University with his bachelor's degree in science of nursing. And then we have Brian, who is a managing partner at Blue Oak Capital. He's the director of investor relations and outreach. And prior to joining Blue Oak Capital, he managed an investment company specializing in residential asset class. He's passionate about helping others succeed. He sources and brokers investment transactions for investors. So without further ado, here is their presentation. Enjoy.
Lisa, I want to thank you and the entire NuView team for having us today. It's a great opportunity to be here, and we're really excited to be here with the NuView client base here. So we're excited to spend a few minutes with you. Can you see my screen here?
Yes.
Are we seeing the right screen, Brian, or am I on the right view?
You're good. You're good.
Awesome. Excellent. All right. Well, again, really excited to be here. I want to thank everybody for spending a few minutes with us. As we go through the presentation here, if there's anybody that would like copies of this presentation, make sure to text this number text NuView to this number. So that way we can make sure to get you a copy of that, and we'll make sure that we drop that in the chat at a certain point. But let's go ahead and get started here by really stating the obvious. Our world is really changing, right, Brian? I mean, we're really facing a storm of economic headwinds, and the likes of which many of us attending this webinar today have really never experienced before. If there's anybody around our age, Brian, we're in mid-30s now. We haven't been around as investors through major economic downturns or cycles like we've seen in the past. And maybe we have certain investors that are attending today that might have lived through some of those economic downturns as investors, but maybe aren't quite familiar with how to navigate some of the headwinds that we're facing today.
Absolutely. And every economic cycle we have is different, right? Every recession is different. So what's going on today, we arguably haven't seen before, especially in the midst of COVID and what we had go on a couple of years ago. So there's definitely some interesting times going on right now.
Yes, indeed. So let's talk about some of those interesting times of those headwinds, right? And let's draw our attention right here. As Bloomberg reported earlier this month, the markets are absolutely puking right now. They're just absolutely being decimated. The forward economic forecast is bleak. Investors are now more pessimistic about the future economic outlook than ever before. Investor sentiment is moving towards all-time lows, which is just exacerbating this massive correction we're seeing in the marketplace.
Yeah, and this correction has been really obvious to us too, Cody, because we work with a lot of high net worth investors, and everybody was kind of standing on top of the mountain a couple of years ago when stocks were at an all-time high and people were getting 20-30% returns on their portfolio. And things have changed very drastically over the last several months, and the market has definitely puked, to use that word. That's a great way to describe it.
The tides have definitely turned, that is for sure. Ben Carlson, wealth fund manager, wrote earlier this month, this is the worst 6 months ever for financial markets in comparison to the S&P 500 data dating back to 1926. What are your thoughts there, Brian? That's a pretty powerful statement to say that this is the worst 6 months ever.
Yeah, that's definitely a headline that catches your attention. Most of us as savvy, sophisticated investors are diversified in some shape or fashion. We don't have all of our eggs in one basket. And to see a headline like this, maybe equities are a large part or a healthy part of your portfolio, it's definitely very damaging. And I know we're looking forward later on in our slide deck, we'll show some charts and graphs that really highlight how much work you have to do when an incident like this occurs. When you have a record high drop in the equities market, what does that mean for your portfolio? If you drop 20%, well, how much do you need to catch up in the next couple of years to really rebound from that negative 20%? So definitely an interesting headline. And when I saw this one, I thought it was a great way to start this presentation. It's important info.
Absolutely. Now, one of the things that may have drawn many of you to today's webinar was really understanding how the ultra wealthy invest through these uncertain times. And, just to give you an idea on what some of those ultra wealthy investors think about some of the latest fads in investing, right? Cryptocurrency being the biggest one that stands out. Cryptocurrency has generated billions of dollars of wealth over the last few years and are claimed to be non-correlated to the equities market. But no surprise that investors' behaviors translated into cryptocurrency investing. And what happened to the crypto market? It puked just like the equities market, right? And we've seen corrections in the crypto market over 50% over the last couple of months. I mean, just absolutely decimated again. And so, what do the ultra wealthy think of fads like cryptocurrency? Well, Bill Gates, founder of Microsoft, says NFTs and cryptocurrencies are based on greater fool theory. Thoughts there?
Yeah, I mean, there's a lot of speculation going on in cryptocurrency. I still like cryptocurrency. I have it a part of my portfolio. I'm bullish on it long term. But the issue with cryptocurrency currently is a lot of people are doing a lot of speculation, which we're going to talk about a little bit later today. And that's part of the thesis today is, ultra high net worth investors, really sophisticated investors, they don't like to speculate. So that's why somebody like Bill Gates, who obviously is one of the richest people in the world, believes it's based on a greater fool theory, because there's a lot of speculation involved. There's really solid coins like Ethereum and Bitcoin, but even those had massive drops over the last several months. So a lot of speculation going on, and another reason why we prefer alternative assets.
Absolutely. One of the other headwinds we're facing is really the labor force challenges, right? We've seen the labor market extremely tighten over the last, call it 12 to 18 months. And unemployment is reaching just over 500,000 jobs, shy of pre-pandemic levels. And right now, for every available employee in the workforce, there's about 10 job openings or so. So what does that mean? That means lower quality employees are commanding premium wage increases. Wage inflation is having a major impact on business owners in a negative way. And that impact is transferring to you, the end consumer or end user of those goods and services, which is resulting in upward inflation pressure.
Yeah, and I think we'll see changes over that. Historically speaking, right? A recession typically leads to lower unemployment. And the one thing about really sophisticated companies is they're not going to stand on the sidelines while they face these employee shortages. So they're going to get creative. They're going to find new ways to implement technology. And as we're in a recession and we see unemployment rise, people are looking for jobs. Unfortunately, those jobs may not be available if employers decided they wanted to switch to some sort of technology. So definitely interesting times. And as a small business owner myself, we faced several employee challenges over the last 12 months. And I think it's going to be something that we continue to see, especially with skilled labor, skilled workforce.
Absolutely. Yeah, it's a big problem, something to pay attention to. And as inflation continues to roar, that's only going to get exacerbated. And, right now we're experiencing 40-year record high inflation. Last week's headline CPI data came out reporting inflation at 9.1%. And so I really want to go back to the audience here and just have you reflect for a minute. How many of you in attendance are really old enough to have experienced the hyperinflation period of the early 80s as an investor? I don't know how many of you are in attendance that have been around, but I would argue that there's probably a significant amount of attendees today that, like Brian and I, who weren't around to have experienced that time. So this is a very scary time for us, having an inflation level at 9.1 when we've never seen that before. And according to Forbes, inflation expectations are still running rampant, suggesting longer inflation timelines, meaning that inflation could potentially linger for years to come. Hopefully not at 9.1%. Hopefully we're going to see the peak of that in next month's inflation data, but this is a real possibility and real concerning for a lot of your experts out there.
Yeah, unfortunately, the Fed, their data is always backward looking, and the changes they make today can often take 6 to 12 months to really show up in the statistics. So we're at 9.1% for the latest print that we saw. We might see a softening in the next month or two, but it's not going to go from 9.1 to 3 or 2 or 4. It's going to slowly go down over the next 12 months. So unfortunately, we could be living with inflation for quite some time, and even longer than that if they can't get a rein of it, but it's still to be determined.
Yeah, absolutely. So, in speaking to the economic forecast, again, several of the industry experts and economists are they're very concerned about what the economic outlook is projecting. And so Fortune magazine just reported 2/3 of economists believe a recession will likely hit in 2023. But unfortunately, we don't have to wait to 2023 to realize that, as we just posted 2 consecutive quarters of negative GDP growth, which by definition is what? Guess what? It's a recession. So we are actively, technically in a recession as we speak. The difference right now versus your traditional recession is that the labor market is still intact and still strong. But Brian, as you pointed out a second ago, we are not going to see the impact of the Fed's monetary policy until midway through next year. So how the labor market will respond to that Fed monetary policy is yet to really be realized. But if you've been following the Fed's monetary policy this year and the inflation data, I think we can all safely assume with confidence that the idea of a soft landing is really completely off the table at this point. Really, the Fed is combating inflation using a demand side lever to combat a supply side issue. And the Fed has acknowledged that. They can't fix inflation with rising interest rates, but when that's all they have to use on their tool belt, they have no choice, right? And so again, just to reiterate, we haven't seen the ripple effects of the current monetary policy in real time, and we won't see those effects yet. We're not going to be able to really see the effects of that work its way through the system, at least till 12 months out, so midway through 2023. So right now, the Fed's only hope is really to manage inflation expectations as we continue to move forward.
Yeah, and if you look at the forward curve, you're starting to see that expectations are in check. But unfortunately, one of the things that they're also not you don't see too often in the headlines is nobody's talking about quantitative tightening as well. The Fed is not only raising interest rates, but they're also pulling very slowly, not at an aggressive level yet. They're pulling liquidity out of the market. So when you look at the inflation and you look at the rising interest rates, and then you look at the Fed also putting liquidity out of the market through quantitative tightening, the idea of a soft landing, to your point, Cody, I don't think that's personally going to happen. They're very likely, as we like to say, to wreck things and break things.
They're going to have to break something to get this course correction for sure. So, well, again, we want to really reference what are some of the ultra successful, ultra high net worth investors are doing in their business. And, one of the probably the most famous real estate investors and author, Robert Kiyosaki himself, who's been a big advocate and fan of cryptocurrencies over the last several years, recently came out with this. He says, I trade Bitcoin, but I don't think it has any value. I just play the game. I just like to gamble a little bit, supposedly. And so, Robert still believes in the power of non-correlated assets and alternative investments as a wealth vehicle. And so, we've got to be really aware of what these smart investors are doing.
Absolutely.
So here's the reality, guys. So we want to take a pause for a minute, because what we've done is we've just outlined a narrative in which the everyday average investor lives and invests by fear and emotions, right? If there's excuse me, but there's reality here, guys, is that there will be winners and losers when it comes to investing. Understanding market shifts and dynamics will help you, the smart, wealthy investor, shift their strategies and make better risk-adjusted investment decisions while minimizing the volatility. So I want to ask a couple of questions to the audience right now before we go any further. So are you an average everyday investor? What will your portfolio look like 1 year from now? Will it outperform the market, or are you going to be a victim to the headwinds like inflation and allow your portfolio to lose its value? Is your retirement account insulated from inflation and volatility? Again, if not, then I want you to stay with us here for a few more minutes, and let's examine how some of these savvy, wealthy investors invest during these volatile and uncertain times. So there's a difference. There's a very distinct difference between investing and speculation. And the smart and wealthy investors know this, right? They stick with a model that works. They never, ever speculate. They don't play the greater fool game. They don't buy into this thesis of buying today at a discount and hoping to sell at a high to a future investor. They never try to time the market. And this is key. And I want everybody to remember this. The wealthy investors know that time in the market always outperforms attempting to time the market.
Absolutely. That's a saying that we say very often, because you can get attractive to try to time the market. But the reality is it's almost impossible, whether you're in equities or you're in real estate or you're in crypto. It's not about time. Like we said, it's not about timing the market.
Absolutely. Again, these smart, savvy, and wealthy investors, they don't get moved or influenced by the noise or the media frenzy that we see in the headlines that we pointed out earlier. They could care less about what the public thinks about their assets, their allocations, or their portfolio, because their assets aren't impacted by the madness of the masses, as we like to say. Liquid assets aren't important to the smart, wealthy investor. Liquid assets are exposed to market sensitivities driven by the herd or the crowd, right? And so remember Elon Musk's reckoning of Dogecoin, if you're a crypto fan, or most recently his acquisition of Twitter, by just putting out a few tweets, and how he can manipulate a market or the market share or stock cost of these particular assets. And so, the smart, savvy, wealthy investors, they don't like that exposure. They don't want that exposure. So wealthy investors invest in liquid assets because they aren't moved or influenced by the market. They are truly non-correlated.
Yeah, and unfortunately, we're well, not unfortunately, but the reality is, Cody, is we're all emotional beings, right? We all have emotions, and that sometimes drives our decision-making process. So it makes a lot of sense when you think about the ultra high net worth. They have liquidity, of course, doesn't mean their bank account's empty, but most of their money is working for them. And they like the idea of illiquid assets because that means that they don't have to make emotional decisions because they can't. These assets are typically illiquid. So it makes a lot of sense. And that's a strategy we definitely try to focus on.
Absolutely. So again, I want to pause again here for just a few minutes and ask a few more questions, Brian, if we can. And I want to ask the audience, how does your investing behavior compare to the investing behavior of the wealthy investor? Really, what is your investing thesis? Are you a speculator or are you truly an investor? Are you investing in recession resilient assets that generate passive income and growth while being insulated from Wall Street volatility? Are you exposed or subjected to the market exposure? Are you speculating or just hoping to catch that next big push or uptrend? I hope not. What are you willing to risk? Let me save you some time and money though. But overcoming losses with gains is extremely difficult. And I don't want you to take my word for it. I want you to take a look at the data here. And I want you to draw your attention to this graph here on the screen. And this graph represents the cumulative gain that you would need to capture the original value of your investment after realizing a loss. And I really want you to, let's take a few examples here just so this can really hit home for you. Let's say, for example, you've experienced a 50% correction in your portfolio. You would need to realize 100% net gain just to fully recover that original value of that investment. Pick another example. Let's say you may experience a 30% correction. Maybe not as severe at 30%, you would still need to realize a 43% gain to realize the full recovery of the original value of that investment. That's substantial. That's incredibly hard to do. And not only do, but also do consistently if you've experienced massive losses. The wealthy investors understand this and they avoid this risk exposure.
Yeah, and I think this is really important, Cody, depending on where you're at in your life cycle, right? If you're in an older age and maybe you're moving towards retirement, let's say you're 10, 5 or less years away from retirement, and you're really planning on retiring with what you have in your IRA, your 401k that are really based on these equities market. We've seen this, right? You've got great stories that you've told, Cody, like in 2008, where people's retirements really got decimated. Imagine needing to retire in 2, 3, 4 years and you see a 30, 40% drop. You don't have the time that you had when you were in your 30s and your 40s to make that kind of recovery.
Absolutely. But again, we don't want you to take our word for it. Continue. Let's look at other examples of the ultra wealthy investors and see what they're doing. And let's take Tiger 21, for example. Tiger 21, for those who don't know, is a very prominent wealth management fund with over 21 members, each having a minimum net worth of about $10 million in liquid assets. And most of those members are typically business entrepreneurs that have experienced some type of major liquidity event during their lifetime. And so Tiger manages over $85 billion in assets for its members. And what assets do they invest in? Well, recent reporting shows that their top asset allocation is to real estate, alternative investments, making up 27% of their entire portfolio. And trailing right behind that is public and private equity. So now that we've kind of shared some insights into how the wealthy investors behave during these uncertain times, I think it's pretty clear to see that, their exposure to volatility and the sensitivities within the marketplace are not their preferred strategy. Let us introduce ourselves at Blue Oak Capital. So we're an independently held private equity group that offers sophisticated alternative investment offerings to wealthy investors that invest, not speculate. We give our investors really what they want. Brian and I have had the pleasure of surveying over 2,000 investors over the last several years. And here's what our investors want. Our investors want certainty. They want predictability. They want insulation from influences that are outside of their control. Does that sound familiar? They want to invest like the wealthy investors, and they invest in boring assets. I know it doesn't sound exciting, but boring assets, our investments, are really what they desire because they're not subjected to the emotions or the fear that we're seeing in the marketplace right now. They don't get drawn into the next shiny investment, or the next best headline investment that we see in the media. They don't speculate, they invest. Our investors invest in assets that are in real demand, like commercial real estate, for example. Our investors follow the data. Again, we give our investors what they want. Our investors want cash preservation. And I'm going to say that again. Our investors want cash preservation, which is crucial right now in times of uncertainty or market volatility. They want cash preservation with non-correlated, stabilized, risk-adjusted, appreciating assets that they can trust. So we actively source compelling investment opportunities that our investors invest in to position their portfolios to align with their investing goals. So through this survey and speaking with these 2,000 plus investors, we've identified commercial real estate as our preferred asset class by investors. You know, this is what our investors have told us what they want to see in their portfolios. And really, when we narrowed it down after identifying that asset class, we really niched down to our geographical focus to Texas. Why? Again, our investors follow the data. You know, the data suggests and concludes that Texas's pro-business environment produces some of the best demographic metrics that can be found anywhere in the country. Again, don't take our word for it. Here's the data for yourself. You know, take a look at this snapshot here on the screen. You can see Texas is the 9th largest economy in the world. And I'm going to say that again. Texas, the state of Texas, is the 9th largest economy in the world. We're the #1 U.S. exporter for 20 plus years. More than 14 million people in the labor workforce here. We're a huge hub for Fortune 500 companies coming into Texas. And because of our pro-business environment, Texas is a leading destination for companies relocating to other states. So what makes us different at Blue Oak then? You know, we're different because we take all of the guesswork out of the equation for passive commercial real estate investments. Unlike other private equity groups, we aren't just looking for the next best deal. We spend countless amount of our own time, our energy, and our effort to source and vet these investment opportunities for our investors that align, again, with their goals. We also work specifically with self-directed IRA investors like each of you in attendance today to help add alternative investments to your investment portfolio. Now, Brian, this is an interesting fact that I think the audience will find interesting here. You know, one of our partners recently had an eye-opening conversation with an IRA custodian at a major financial institution. And in this conversation, the custodian revealed that out of all the IRA owners who set up their accounts to be self-directed, over 50%, again, I'm gonna say 50% of the account holders fail to ever direct any of their own investments, preferring to let the custodian continue to make investment choices for them. And so I really want to put this back on the audience here and just reflect for just a second. Let me ask you here, why do you think that is? You know, is it fear, maybe lack of knowledge? Maybe some people aren't comfortable making those decisions. What do you think, Brian?
Yeah, there's definitely a lot of decisions, and a self-directed IRA is such a powerful tool. It's a tool that we definitely recommend investors use, especially if you have a lot of exposure in the equities market. But the only concern with the self-directed IRA is that now you have the power, right? You have the choices. So getting educated is super important. All of you that are on this webinar today are ahead of your peers, so to speak, because you're getting educated in the type of alternative asset classes that people like that are high net worth investors are investing in. So the next thing, which I know we're going to talk about here in a second, Cody, is once you're educated, is you actually have to take action. You can't be afraid of the fear. As long as you have the knowledge and you're making educated decisions, you got to go out there and take action. Otherwise, you're at the point we talked about earlier where we're at 9.1% CPI. Your money is losing value. So you got to go out there and take action.
100% agree. 100% agree. And to your point there, I think maybe some of the things that might be holding people back is there might be too many options. They need direction, right? They need help where to go. So, but you know, if you're setting up a self-directed IRA, why wouldn't every IRA account holder want to control the allocation of their investments, right? That's why we set it up self-directed, so we can have control and influence on, you know, where our investments are allocated outside of the limitations of Wall Street. Right. And those are assets that, again, commercial real estate, other alternative assets classes in real estate, private equity, oil and gas, commodities and such. And as many of you know, I think as Lisa was highlighting earlier in the introduction, The Roth self-directed IRA funded after tax dollars, all investment gains are tax-free. You know what? There's not too many other investment verticals that can promote that. So after all this discussion and after this overview, I want to ask you a few more questions, and I want to get a little personal here with you. And I really want you to reflect on these few questions. Number one, what is your investment objective? What assets can you invest in that will help you achieve your objectives? What assets interest you? What investments are you knowledgeable about? Are you willing to defer to the expertise of others to fill in those knowledge gaps? And how can you invest in the assets of your choice? Well, you got the perfect vertical in front of you with your self-directed IRA. So are you going to be one of the 50% that haven't invested their account? I hope not. Are you going to continue to not take action if you are? Man, just as a reminder, Brian, you just mentioned it a second ago, inflation's 9.1%. If your money is just sitting there, your buying power is being eroded by 9.1% annually if you're just letting it sit idle. So the velocity of capital is important. You have to get your capital invested. So Brian and I know that each of you attending today are very, very smart, savvy investors. I know that you guys aren't the ones just sitting back, letting your accounts just sitting there. And I know that you're here today because you want to learn more about how the wealthy are investing, especially during these uncertain times. And so I want to invite you, if that's you, I want to invite you to visit this URL here. Make sure to go to blueoakinvest.com/SDIRA and find out how you can invest and preserve your capital and invest like the wealthy do during these uncertain times. Brian, any closing comments?
No, I think this is a really important message, and for people to understand that you got to go out there and take action and look at alternative asset classes. It's a powerful tool, like I mentioned earlier, to have that self-directed IRA and to have great custodian like NuView in your corner, but you got to go out there and take action. You can't be waiting for the right time. It's like we've mentioned before, especially with alternative illiquid assets like real estate. It's not timing the market, it's time in the market. So get educated, find a great operator that you can trust your hard-earned capital with, and go out there and make some investment decisions that are going to help you protect your wealth, preserve your capital, and eventually lead you to a position where you're potentially at today, where your portfolio is down 20-30%.
Absolutely, man. Great way to close this out there. And with that, Lisa, we'll turn it back to you.
Thank you guys so much. I like the interaction, and it kept me intrigued, and I appreciate the points that you made. And NuView, we are a passive custodian, so we're not able to give that investment advice. And it is important for people to do their due diligence and feel comfortable with what they're investing in and take that action. So we're going to open it now to questions. If you have any questions that you'd like to ask, I know that Cody and Brian both said that they were going to put the contact phone number in the chat. Were you able to do that?
I will do that right now.
Okay, awesome. That way, if we don't get to your question, or if there aren't any questions that you want to ask publicly, feel free to ask them via that chat feature, or text like they had mentioned earlier. Or if you want to reach out to us directly at NuView, I'll have a slide here shortly that you can have our contact information and reach out to us. Any other questions? Any questions? All right, well, I'm going to go ahead and move on to the next slide and closing here with NuView. We do have an opportunity, if you'd like to reach out and learn information about the NuView Trust side of things, you can email iraspecialist@nuviewtrust.com. We also have a promo. Oh, look, there is a question here. With real estate seemingly so inflated in the last 2 years, is it still a good alternative investment channel?
Absolutely. And I think that goes back to our comments about be careful what you see in the headlines. The one thing that you need to understand about real estate right now, whether it be residential or commercial, is yes, we've seen rapid accelerated asset values in real estate, but there's a reason for that. There's a supply demand dislocation. We are so short of housing inventory across residential real estate that the demand is far exceeding the supply. And the reality is our development pipeline is simply not keeping close pace with that demand. And so if you look at, recent data suggests as at the turn of the year, we were short several million homes, residential homes, which is very hard to absorb and accumulate for. So the point is that the fundamentals that are driving demand for real estate are extremely positive. We are seeing a high demand, and particularly for rental housing, affordable rental housing. And so the fundamentals are very positive, and we still see a very bright runway for rental real estate for probably the next 3 to 5 years for sure.
Yeah, I think I'll chime in on there. I think the strategy that you decide to execute, especially if you're using your self-directed IRA, is really important right now. People often say, I want to invest in real estate. Well, that's a very broad asset class. It's like saying, I want to invest in stocks. So like, well, what kind of stocks do you want to invest in? And what's your strategy with stocks? Real estate's the same way. I think if you're going to invest in real estate, there are some risky verticals in real estate right now. So I'll give you an example. Right now, I would not want to be a house flipper. I wouldn't want to be a house flipper because right now we're seeing interest rates for residential real estate rise so fast. If you put something under contract and it takes 30, 60, 90 days for you to renovate that house, that ARV that you thought you might get when you put that house under contract before you close, which could have been 4 or 5 months ago, could be very different than the ARV you actually have today. With a rising interest rate environment, depending on what type of housing you're looking at, is this affordable housing? Is it kind of B-class assets? Is it A-class assets? Your buyer pool might be drastically smaller than you thought it would be. So you could get left in a situation, especially if you're using your self-directed IRA as like a hard money or private money lender, you can get in a situation where you aren't able to exit at the ARV that you thought you were. Same thing for following the BRRRR strategy and refinancing houses. Well, refinancing houses is also really hard right now because of the interest rate environment, where you might actually not be renting that house at a rate where it actually makes you money if you're following the BRRRR strategy. So those are just 2 great examples of verticals that I'm not saying don't do it, but you just have to be conscious and careful of. But to highlight Cody's point, rental housing in particular is really valuable right now, whether you're owning residential real estate or you're buying multifamily apartment complexes as an asset class, for example, because as I just mentioned, and as Cody mentioned, 1, there's a shortage supply of affordable housing. And then 2, where are all these people who were formerly qualified to buy a house when interest rates were 2.5%, 3%, and now they're 6%? These people can no longer afford to be qualified, especially if you're buying your first home, you're buying your starter home, or you're buying a lower middle tier house. A lot of those people don't qualify. So they're forced to rent. They're renters by necessity versus being renters by choice. And that's going to be very attractive to anyone who's a landlord who has residential housing, or also to multifamily housing, people that own apartment complexes. So I would say definitely do your due diligence on the vertical. Just saying, is real estate safe to invest in is not enough of a detailed question. Make sure you dive a little bit deeper before you make a choice.
Well, Brian, and you just summed up very well one of the points we made a few minutes ago, right? Which is distinguishing the difference between speculation and actual investing. If you're getting into real estate on the short-term approach, i.e., hard money lending, flipping, or whatever, that's speculating, right? Investing in real estate and truly investing in real estate is a long-term approach. It's not a get rich quick overnight scheme. You're not just going to turn around and flip deals every 6 to 12 months and build yourself to wealth. You may accumulate cash, but that doesn't accumulate wealth. So if you're going to invest in real estate, taking a safer approach is taking a long-term approach. That's true investing.
And then we did get another question. What are some crucial economic indicators that investors should look at besides inflation and rates? Is there anything else that you guys look at?
Yeah, I think right now, really one of the 2 most important variables I would tell people to really pay attention to, again, is the unemployment rate in the labor market and the credit markets. Right now, there's still a very healthy appetite for lending. However, as Brian alluded to in the presentation, is liquidity is continually being pulled out of the market, which puts more pressure on lending institutions to be able to lend out to buyers or investors or borrowers, right? And so I think those 2 variables are something that you really need to pay close attention to. If credit markets continue to tighten to a point where lending becomes challenging, we could start seeing a true softening in the marketplace that could leave some people exposed.
And then we have another question. What about vacant land for long-term investing, residential versus commercial?
Great question. I don't know that Brian and I are the best ones to answer that. We unfortunately do not have any allocations towards just vacant land, although we have or know several people that are quite successful in that space. But I don't know that we'd be the best ones to give you any insights there. So
yeah, Randy, I think for vacant land, I think it's a great strategy. I don't know how much of my portfolio I would allocate to that. The challenge I have with that is there's not an income producing element of it. And right now, the point we've really been hammering home is how heavy inflation is right now. When inflation is 7, 8, 9%, the beautiful thing about commercial real estate, whether you're in triple net, or well, triple net's a little longer, short-term leases, so residential housing, if you have Airbnbs or if you're in multifamily in particular, is our rents are, typically 12 months leases or less. So we can actually, depending on where you're at in the market, that's your best hedge against inflation, is that you can go out there and push the rents as inflation continues to grow. Obviously, there's a ceiling. You can't push them to the moon, but within reason. With vacant land, you have a piece of land, which is great. It might be appreciating, but it doesn't produce you any income per se. So it's probably not going to produce that same great hedge against inflation. That's something that has a tenant in it would, but I still think it's a potential great play. I don't know enough about it, and I would be more concerned about the income producing element of it.
And then we have, with regards to real estate would going the REIT route be better and risk adjusted compared to actual properties owned?
I think that's a question that you have to answer for yourself internally. But my comments on that is, what you have to understand about a REIT is equivocal to buying a stock. It's a correlated asset type, and it's backed by real estate. And so you're investing in a company that acquires real estate in volume, and you're buying an equitable share of that. And you arguably don't know who's the one that is at the head of the ship. You don't know who's buying the acquisitions, where they're buying the acquisitions. You don't have any influence or input into that decision making, nor do you get to participate oftentimes in the benefits of tax depreciation, which is one of the things that draws people to real estate as well, is protecting that wealth that they build, right? And so going the private placement route and working with people like Brian and I gives you the advantage of having a relationship with the people that are actively doing the deals, actively acquiring the deals, and you have more control over where your investment dollars go. If you don't like a particular market or a particular asset, you're not subject or obligated to invest in that particular asset. You have the full power to make your own investment decisions, where in a REIT, you do not. So I would encourage you just to really look at, again, the pros and cons of looking at REITs, but I would encourage you to really consider the private placement route if that's of interest to you.
Yeah, Cody, I'm going to add a couple of things to that. I think you hit the nail on the head. You have to ask yourself, I would say the only benefit to a REIT, besides the common stuff, is the fact that it is a stock, it is an equity, and it's liquid. That means you can sell your REIT anytime, just like you would a stock. But we just hammered home the point on our presentation that smart, savvy, high net worth investors really value the illiquidity part of private placement. The second question I'll ask you to consider, VK, is whose best interest does the REIT have in mind? For us over at Blue Oak Capital, we work one-on-one with our investors. We have a relationship with our investors. We're not just taking people's money randomly who walk off the street. So we are a fiduciary to our investors to make sure that we buy properties that are producing the types of results of what they're looking for, right? Cash flow, potential appreciation, cash preservation, with the upside as well, of course, right? So we have a relationship with all our investors. You're not going to get that at the REIT, which is a point Cody was just mentioning. So each one is for, different types of investors. There's no right or wrong, but you need to ask yourself, what do you really value the most?
All right. Well, thank you guys. I think that is all the questions that I see listed here. We'll go back to the slide. So if you have any questions on the self-directed side, feel free to reach out to IRA specialists at NuViewTrust.com. We also have our social media pages, and you can scan that QR code there to stay up to date with us on Facebook, Instagram, YouTube, LinkedIn, etc. And then we are running a promo at this time. It will run through August 15th. So if you open your account today through August 15th, we will waive the account opening fee of $50. and you can scan that QR code to do so and get your account opened and start self-directing. So thank you again, Blue Oak, for your time and energy towards educating our client base. And we appreciate everyone who attended and your time today. Have a wonderful day.